broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everyone. Thank you for joining tonight's webinar. Tonight's webinar is using equity in your home to invest. Most of you know who I am. My name is Ryan Love. I'm a financial advisor at Apex Partners. I'll be going through the webinar tonight. Tonight's session should take between 15 to 20 minutes, depending on questions at the end. In terms of if you do have a question that you'd like asked or answered during the webinar, you'll have a control panel on your screen where you can type in a question, and we will endeavour to get back to that at the end of the session. Just a bit of housekeeping matters. Tonight's session will be recorded, so there will be a video copy uploaded to our website tomorrow, along with a copy of the presentation slides, which will be made available also to you. Before we get going, just a quick matter. In terms of what we will be going through tonight, it is obviously general information only. If you have any questions specific to your own circumstances, by all means, please either give me a call at some stage or arrange a face-to-face meeting, and we can go through something specific to you. But what we will be going through tonight is general information only. The topics that we're going to cover is obviously the key theme, using equity in your home to invest. We'll talk about what equity is and how it's defined. We'll talk about what is LVR, or loan to value ratio, a key term used when talking about equity in your property. We'll go through a structure and look at what it looks like to draw equity out of your home. Then we'll go through our first case study. The first case study will be using a lump sum as an investment. And the second and final case study will be looking at drawing equity under a regular investment plan. So tonight's theme, obviously using equity in your home to invest, we first need to understand what equity is. So I've put up there a structured diagram to sort of help explain what we've got. So we've got a principal place of residence, PPR, or a home that is valued at $750,000. Now with this home, there's the bank. The bank has a mortgage over the home, and they've advanced a loan of $450,000. So to work out how much equity this person has in this home, it's a very simple calculation. The calculation is the property value minus the loan balance. So in this example, we have a property value of $750,000 and a loan balance of $450,000. So $750,000 minus $450,000 is $300,000. So that's the terminology equity. This person has $300,000 equity in their home. In terms of the next concept I want to cover off is LVR, known as loan to value ratio. So when you talk to banks, they'll quite often talk about LVR. So we better talk about what it is and how it's calculated. So again, we've got the exact same structure diagram up there. We have a principal place of residence valued at $750,000 and a $450,000 loan balance. LVR, loan to value ratio, is the loan balance divided by the property's value. So in this case, we have a $450,000 loan balance, or total debt of $450,000, and a property value of $750,000. So when we work out that division, the ratio is 60%. So loan to value ratio is 60%. So quite often when you talk to banks or you talk to a mortgage broker about getting some finance, that's one key calculation they're looking at, is the loan to value ratio. So you're working out how much equity you've got and how much money the bank needs to kick in terms of purchasing the property or advancing the money. Now we'll look at what it looks like to have an equity loan structure. Again, we'll keep the diagrams the same. So we've got the principal place of residence, or the property, valued at $750,000. The bank has a mortgage over that property, so they've got security, and they've got a $450,000 loan, which we're calling here Loan 1. So it's the first loan that we put up on the structured diagram. So Loan 1 is $450,000. The change in this diagram from other diagrams is we now have Loan 2. So Loan 2 is a new loan, a new equity loan that again is advanced by the bank, and again the bank has a mortgage over your property, and it's for $150,000. Now obviously if they're going to lend you that money, they're going to want you to do something with it, and you're going to go and invest. that money. So loan 2 is used for investment purposes. Now when we talk about investment, that could be a number of different things. It could be buying a parcel of shares. It could be buying a managed fund. It could be buying another property. It doesn't really matter what it is as long as it's for investment purposes. That does a couple of things. One is it gives the bank a bit more comfort, and it also means that you've got the potential for tax deductibility on the interest on that loan. Within this structure itself, there's something to note that's obviously very important, is we've now advanced more money. So we've now got a new LVR, or loan to value ratio. So just work out what our new LVR is. We've got $450,000 loan 1 and $150,000 loan 2 and a property value of $750,000. That new loan to value ratio is 80%. And it's an important number to keep your loan to value ratio at 80% or below 80%. Banks are really heavy on making sure that their loan to value ratio is 80%. If you go above 80%, generally speaking, you're going to have to pay lender's mortgage insurance. Now, lender's mortgage insurance is insurance that covers the bank in the event that you default. So you pay that insurance to give the bank more comfort if they're lending you more money. So as a general rule, if we're going to consider using an equity loan structure or using equity in your home to invest, you'd want to be thinking of having at least 20% equity, preferably more, in your property before you consider doing this. Assuming that you do, we'll go through now a couple of case studies. So we've covered off what equity is, we've covered off the terminology loan to value ratio, and we've covered off what the equity loan structure would look like. So we'll go through a case study to give this some flavour and so we can put some numbers to it. So case study number 1 is using a lump sum to invest. So in this example, we've got a lump sum investment of $150,000. And in this circumstance, we have a client. Now the client has a tax rate, and tax is an important consideration when thinking about investing, of 38.5%. That's a marginal tax rate, shouldn't be per annum, that's a mistake. It's 38.5%. But in other words, they earn between $80,000 per year and $180,000 per year. So that's their income range where that tax rate would apply. Now in the example, we'll stick with the same numbers. They've got an opening mortgage balance of $450,000, and they're going to pay that off over the next 25 years. So they're accepting that they've got a 25-year loan profile with a $450,000 loan. Obviously, they're drawing out a new loan of $150,000, and they're going to use that $150,000 to invest in a share managed fund, so a diversified fund of Australian shares. Now, we have to make some assumptions as to what rate of growth they're going to get in that share fund, and we've assumed a rate of growth of 6.5% per annum. We also have to make some assumptions about income, so how much income and dividends that those companies are going to pay and pass through to the ultimate unit holders in that fund, and we've assumed 3.5% per annum after tax. So there are a couple of the assumptions that we've used. Now we'll look at what it means from a cash flow perspective. So I want to spend a little bit of time just going through this table and what this table means. So we can see here we've broken up into loan 1 and loan 2. So if you refer back to those structure diagrams we had a few slides ago, we had loan 1 and loan 2. So loan 1 is the regular mortgage. So that's $450,000. If the interest rate on that loan is 7.5% per annum, that's $33,750 worth of interest that is payable in the first year. They'll make a principal repayment, so a reduction of the loan amount, by $3,803 in the first year. The interest, or the investment income doesn't apply to loan 1. At this stage, there is no investment income, and obviously the interest isn't tax deductible. So we add up the total after-tax cash flow for loan 1, so the total repayments throughout the course of a year is $37,553. And that's a monthly principal and interest loan repayment of $3,129. So that's nothing new. That's a standard concept. If you're going to borrow $450,000 from the bank to purchase your home, and you're going to pay it off over 25 years, and the interest rate is 7.5% per annum, then your regular monthly payments are going to be $3,129. So there's nothing fancy there. That's just standard bank talk as if you're going to have a normal home loan. Now we want to spend a bit of time talking on loan 2, because loan 2 is a new loan that we're introducing, an equity loan, so using equity in the home to invest. And that's a new loan with an opening balance of $150,000. Because we're borrowing money, unfortunately, the banks won't give us the money for nothing. We have to pay interest on that as well. And the interest at 7.5% per annum is $11,250. So that's a cost to us when we borrow money. We're not going to repay the principal on this loan 2, so that means that's going to be an interest-only loan, so there's no repayment of principal. But we recognise that if we use that loan 2 to go purchase a share fund, then we're going to get some income from that fund. And the income at 3.5% per annum is going to be $5,250. That's cash flow that comes back into us for being an investor. We also, as if we're an investor, what we're going to be able to do potentially is claim the interest cost. The $11,250 is tax deductible to us. So that means that if our marginal tax rate is 38.5%, then we get 38.5% of our interest cost back when we do our tax return. So when we add up the addition of the $11,250 cost plus the cash inflow coming back in on a per annum basis or an annual basis, loan 2 is costing us $1,669, roughly $139 per month in additional cash flow. So in this circumstance, if you've got time to add everything up and account for the tax deductions, to borrow the $150,000 and provided you get that level of investment income, it's costing you around $140 a month to have a position or to have an investment available to you. So we'll have a look at what that looks like diagrammatically. So we've got a chart here. Now this chart looks at a few things. It looks at the projected investment value growing at 6.5% per annum capital growth. They also look at what the loan 1, the regular loan, looks like and how long that takes to pay off, and also look at the loan 2, which is the interest-only loan that we're using for investment purposes. So start by looking at the investment value, projected investment value. Now obviously in a perfect world we've got to accept that share markets and share fund investments have a thing called volatility. That means that they go up and down in value over time. We've assumed 6.5% per annum as a rate of capital growth. Now that's roughly historical rates of capital growth over the last 10 years. But we've got to recognise that some years are going to be really good years and some years are going to be really poor years. Now, when you chart it like this at 6.5% per annum, it looks fantastic, but there is volatility to take into consideration as well. But what it does go on to say, I guess, is that if we can achieve that rate of growth, our $150,000 that we initially invested started with, at the end of 25 years, it'll be worth about $750,000 in terms of capital values. That's unrealised capital gain before accounting for tax. Loan 1, which is our regular home loan. So we start with a home loan of $450,000 and we're just going to pay that down off at the end of the 25th year. We've fully repaid our mortgage. So that's the standard situation. That's what we recognise that we're doing. But what we have done is introduce a new loan, loan 2. So loan 2 is the red line along here, which is the original loan of $150,000 that we're using for investment purposes. Now you recall from the previous table that that loan, under this circumstance, accounting for the investment income, costs about $1,600, $1,700 a year to maintain. So obviously you need to have that cash flow available, or around $140 a month, to consider this strategy. But I guess where it becomes really powerful is if you do get some capital growth. And particularly, you've got to think about this over long periods of time. So when you look at this chart, you look at the projected investment value growing over time and well above the red line there. And the difference between the top bars along the projected investment value and the red line is what we call an unrealised capital gain, or I guess opportunity for wealth creation. So that's quite powerful if you achieve that rate of capital growth over a period of time. Now I've got a share fund investment. Obviously you can have an investment property in there potentially as well, but you just got to weigh up the cash flow and the costs and how it fits in with your overall situation. So that's drawing equity out of your home to invest